Imagine standing on a busy street corner, watching a wave of people surge forward, all heading in the same direction. There's an energy to the crowd, a sense of urgency, of shared purpose. It's easy to feel swept up in the momentum, to let yourself be carried along. This is the same feeling many experience when it comes to crowd investments. There's excitement, the allure of rapid gains, and the comforting thought that if so many are joining in, it must be safe. But just as following a crowd across a street without looking can land you in trouble, so too can following investment trends blindly. The skill of assessing risks when participating in crowd investments is more important than ever in today's fast-paced, interconnected world. At the heart of crowd investing lies the collective. Platforms offer opportunities for many individuals to invest in projects, startups, or assets, pooling resources to achieve more than any one person could alone. It's a democratization of investment, allowing ordinary people to participate in ventures once reserved for the wealthy or institutions. Yet, with opportunity comes risk, and the very nature of crowds can lead us astray. The first step in mastering this skill is to understand the psychological forces at play. Crowd psychology is powerful. We are social creatures, hardwired to seek safety in numbers. When we see thousands flocking to a new startup or a trending coin, our instincts tell us it's a good thing. But markets are not immune to herd behavior. Time and again, history has shown how crowds can drive bubbles. Think of the tulip mania in the 1600s or the dot-com crash at the turn of the millennium. The crowd, driven by emotion and hope, can inflate values beyond reason, leaving latecomers exposed when reality sets in. To assess risks, you must learn to step back from the crowd, to create a pause between impulse and action. Start by asking yourself, why is this investment attracting so much attention? Is there genuine value, or is it simply the momentum of popularity? Look beyond the hype. Read the project's white paper, study the business model, scrutinize the team behind it. Does the venture solve a real problem? What are its chances of success in a competitive market? Another crucial aspect is understanding the level of transparency and regulation. Traditional investments are often governed by strict rules and oversight, offering some protection against fraud or mismanagement. In contrast, many crowd investments operate in newer, less regulated spaces. Crowdfunding platforms may lack the rigorous checks that accompany stock markets or bond issuances. Ask yourself, what safety nets exist if things go wrong? Is there an independent audit, or are you relying solely on the project's word? Diversification is a time-tested tool for risk management. Resist the temptation to put all your eggs in one basket, even if the crowd seems convinced. Spreading your investments across different projects, industries, or asset classes reduces the impact if one venture fails. Remember, crowd investments, especially in early-stage startups or experimental technologies, have a higher rate of failure. Accept this reality and invest only what you can afford to lose. A critical but often overlooked step is to examine your own motivations. Are you joining because of solid research and belief in the project, or because you fear missing out? The fear of missing out, or FOMO, is a powerful driver behind many poor investment decisions. It clouds judgment, pushing us to act quickly before opportunities disappear. But wise investors know that good opportunities are rarely gone in a flash. Take your time, do your homework, and never let emotion override logic. Next, consider liquidity, the ease with which you can access your funds if you need them. Many crowd investments lock up your money for extended periods, sometimes years, with no guarantee of a return. It's vital to understand the timeline and exit strategy. Can you sell your stake if your circumstances change, or are you committed for the long haul? Projects that offer a clear roadmap for investor exits are generally safer bets than those that do not. Reputation matters. Before committing your resources, investigate the track record of the platform facilitating the investment. Is it known for due diligence and investor protection, or have there been complaints of mismanagement or fraud? Check for reviews, regulatory approvals, and any red flags in the public record. The internet has made it easier than ever to research, but it's up to you to use these tools wisely. It's also essential to understand that in the world of crowd investments, early information is not always accurate. Projects often present best-case scenarios, highlighting massive potential while downplaying risks. Learn to read between the lines. Examine the assumptions behind projections. Are revenue forecasts realistic, or are they based on unproven demand? Seek out independent analysis and expert opinions, not just the marketing materials provided by the project itself. One of the most practical steps you can take is to connect with others who have experience in crowd investing. Join forums, attend investor meetups, or engage with online communities. Listen to stories of both success and failure. There is wisdom in the experiences of others, but be wary of echo chambers where only positive outcomes are shared. A balanced perspective is key to sound decision-making. Set clear goals before investing. Are you seeking quick returns, or are you willing to wait for long-term growth? How much risk are you comfortable with? What is your financial situation if things go wrong? Write down your criteria for what makes an investment worthwhile, and stick to them, even when the crowd urges otherwise. Finally, always remember that risk is not something to be feared, but to be managed. Every investment carries uncertainty, but through careful assessment, you can tilt the odds in your favor. The skill of evaluating risks in crowd investments is not about avoiding risk altogether, but about making informed choices, protecting yourself from avoidable pitfalls, and positioning yourself to benefit from genuine opportunities. In the end, the crowd is neither inherently wise nor foolish. It is simply a force. The art lies in knowing when to follow and when to step aside, in having the courage to stand alone when necessary, and the humility to learn from both triumphs and mistakes. Let the crowd's energy inspire you, but let your own judgment guide you. For in the vibrant world of crowd investments, the most valuable asset you have is your ability to think clearly, act deliberately, and invest with both heart and mind.